In Chapter 9, we're looking at more closely how banks make money. And we do this with the focus being on commercial banks. The types of banks, like the bank names that you would recognize on a national basis, like your Bank of America or U.S. Bank or Wells Fargo. Um, and not necessarily credit unions or regionally based banks. To do this, to look at how banks make a profit, we need to understand their accounting structure. What do their assets and liabilities look like? And obviously, maximizing the difference between revenue and expenses brings in your maximum profit. Um, and how do you manage your assets and liabilities to maximize that revenue and minimize your costs? The other part of this is that we need to go refer back to the previous chapter where we talked about the existence of asymmetric information and obviously credit risk that exists whenever money is lent out. And we need to look at how banks manage that credit risk, as well as the fact that even if individuals do pay everything on time, interest rates do change over time. And as an interest rate gap emerges, there's extra expenses taken on by the firm. So, from an accounting perspective, which not all of you would have taken an accounting course, but as a kind of a brief introduction to some of the accounting practices within a bank, banks have a balance sheet in general has assets on the left side, liabilities on the right side. And the key point there is that you want the left side of the balance sheet to equal the right side of the balance sheet, assets to equal liabilities. Well, assets equal liabilities plus shareholder equity, but we're going to disregard shareholder equity existing. So let's just think of it as assets and liabilities. What are the liabilities of the bank? So the liabilities would be basically anything that the bank owes in one way, shape, or form. One of those, the biggest one, being checkable deposits. That would be individuals saying that they have money in their accounts, whether it be a checkable deposit, like a checking account, or a non transaction deposit, like a savings account or a CD. Because there are individuals who have legal claim to money within that bank, that acts as a liability. Banks also can borrow money to fund their operations, and that money that they borrow would also be a liability. Finally, we would have bank capital. That would mean essentially money that's money that's borrowed for the purposes of equipment, technology, structures, buildings that the bank is going to use, and that's going to serve those loans are going to serve as borrowings of capital. On the other side of the balance sheet, in terms of assets, the biggest one would be reserves. Reserves would be a portion of the deposits that are not lent out to others. So it's just money kind of like sitting in the bank vault, that kind of equivalent. Then you've got cash items that are in the process of collection. Most of the time, this is, for instance, like checks that haven't cleared yet or are in the process of clearing. Deposits at other banks. So banks can hold deposits at other banks as a way to like provide a security, let's say, if they have a lot of transactions going on. Banks also hold a sizable number of securities. These securities take the form of government bonds, essentially. And then you've got loans. The loans that are made to individuals, those loans are an asset because it is something that has some value. And then you've got other miscellaneous assets. This would be wholly owned capital that's already owned by the bank. And you can see here that for typical banks in June of 2017, this is what our assets and liabilities look like. The reserves and the bonds and securities being the primary assets. And the liabilities being the savings deposits primarily, and the checkable deposits making up the bulk of everything else. The book has a pretty good description here, which I'd encourage you to use or think about in terms of what is an asset and what is a liability. An asset is anything that the bank, how it's used its funds, and the liabilities would be where did it get those funds from. Other assets then include real estate. So the real estate, that's mortgages, that's commercial properties. Then you've got commercial and industrial loans. That would be kind of like business loans, essentially. And then you've got other miscellaneous things here. Now, you may have looked at this before in Econ 131 about how do banks create money in terms of the lending process. How does the money supply increase? Let's just kind of quickly review it here. So let's say that an individual deposits $100 in cash that they found in a book on their bookshelf. Let's say $100 was in the book on the bookshelf, and the person goes to the First National Bank and deposits it in their checking account. So what that does in the first moment is it creates an asset and a liability of the same amount. The asset would be that the bank takes that $100 check and it puts it, or $100 in cash, and it puts it in its vault. That's the asset side. And then the liability is increased by the exact same amount because now I, the person who found the money, now have a checking account statement that shows $100 more. Then it's going to split that money, that $100, into reserves. It's going to change it from cash that's sitting in its vault into reserves. And it's preparing itself to lend that money out. On the other side here, what's being portrayed below is if a person writes a check, let's say, and deposits it at the Second National Bank, then the First National Bank would lose that money. But banks make money. The second bullet point is the most important. Banks make money by borrowing short and lending long. What that means is that banks make money by lending out their deposits. Right? So when we deposit money in the bank, it's going out the door and it's going to someone else who needs the money. As a example, my mortgage is from Central Pacific Bank. Central Pacific Bank, 100% of their loans, my mortgage and including many, many others, all loans are 100% financed by deposits. Right? So, perfect example of that. The way that the bank is making money is that, right, Miss, Nakamura, right, the old grandmother, 90-year-old grandmother, widow, and, getting 0.05% interest on her checking account, right? She's 90 years old. She saved her money. She owns her house. She's just having it sit in that checking account. And Central Pacific Bank is paying her, let's say, 0.05% interest on whatever's sitting in her checking account. Well, then the bank, Central Pacific Bank, lends it out to Scheiding for 30 years. Right? And in my case, I got charged 2.875%. 2.875 versus the 0.05 that's being paid to the old woman. That 2.8% difference, basically, is where Central Pacific's making the money. Now, when we talk about then, with that basic knowledge about how banks make money, now we need to talk about what are some of the general principles of bank management. First, and we're going to talk about each of these in great detail, but I want to spend just a few moments talking about what each of these mean. First, we've got liquidity management. Liquidity management means, does the bank have enough cash on hand? Is everyone, right, is when the old grandmother comes to the bank and she makes a withdrawal, is the bank handling its cash well enough that it can meet all depositor requests? Because they don't want to run out of money, right? The moment the old woman comes to the bank and the bank says, dude, sorry, we just lent out the money, that's what causes a bank scare. And will certainly cause some regulatory questions. So you need to manage your liquidity well if you're a bank. You need to manage your cash well. Second, we've got asset management. This means, is the bank acquiring assets, meaning loans? Is it making loans in a way that the risk level is acceptable and that the risks it's taking on are well diversified? Again, this is going to be primarily in the kinds of loans it makes. Central Pacific Bank, the example I'm just using here, in the last financial crisis, the bank almost failed. And the reason why it almost failed was because they had made an expansion into undeveloped commercial property on the mainland. And they were lending out money to undeveloped land in California. It was a bad bet, and it failed, because then the housing crisis happened, and undeveloped land dramatically lost its value. And then all those mortgages that Central Pacific Bank underwrote went bad. Today, Central Pacific, and it sounds like I'm making a commercial here for the bank, but I'm not. It's just a good example here of the thing that they do very well that, for instance, Banco doesn't do as well, is that they are very good at small business lending. So like dentists, optometrists, especially dentists and optometrists, they're very good at making out loans for those kinds of businesses. That's part of liability management. Managing the loans that they're taking on that they're not too risky. And it's probably hard to be a dentist and not make money, right? Because people have to get their teeth cleaned. Then we've got capital adequacy management. How much capital should basically the bank maintain over time? How much is needed? Credit risk. how many borrowers are we think are going to default? Are we managing that side of our risk well? And then finally, we've got the interest rate risk. How much of our earnings is subject to the interest rate changing? If the interest rate changes, how much money does our bank make or lose? And so here, what you start to see here is then the bank starting to lend out money. It lends out its excess reserves. So, in this case here, if the bank is required to hold 10% in required reserves, then it may put that into either vault cash. It could make the deposit actually at the Federal Reserve, but it could also put it into securities that are not going to alter. Now, this bank also has excess reserves, and we can see it has excess reserves because that 100 million was put in. 10% of 100 million is 10 million. The difference then would have been they could have lent out 90 million, but it did not. In this case, it's holding some excess reserves. And on the right side, you would see that if the bank is taking in $100 million total, that it could reduce its reserves down to $10 million in required reserves. And then the money it can lend out is being now split into $80 million for loans, $10 million for securities. And so this is an example here where we've got excess reserves. In this example here, the excess reserves have been eliminated. Now, what if the bank ends up having a shortfall? What if it lends out too much money? Well, that's a significant problem. And you've got to resolve that quickly. Because the moment you fall below the the required reserves, regulators are going to come in and look at what's happening. So that's one benefit to holding some excess reserves, is it gives you a cushion in case the old woman all of a sudden comes and wants all of her money, and you get one or two other depositors that want all of their money. I could end up being short on reserves. And the excess reserves would be that insurance policy to avoid that from happening. If it didn't have excess reserves, it could borrow the money from other banks in what's called the London Interbank Overnight Rate, LIBOR. When we talk about why did Lehman Brothers fail, the investment bank in 2008, 2009, that investment bank, so it's not a commercial bank, but that investment bank failed because banks refused to lend it money at almost any price. Banks, as well, as we just showed here, that not only can they devote some of their deposits to loans, but they can also devote it to securities. Securities, again, would be like treasury bills, other government-sponsored entities. You don't want to hold too much cash You don't want to hold too much in assets in these forms, though, because they are a little bit more costly. And so there's going to be some higher transaction costs involved with these kinds of things. You can, if you're really running out of cash as a bank and you don't have your required reserves, you can also borrow from the Federal Reserve if needed. That's not the way you want to do it, though. Because the moment you start doing this, the Federal Reserve is going to ask, well, why do you need the money? And that's going to add to all the questions. But I'd rather do that. I'd actually rather borrow from the Federal Reserve than call in some loans. You really don't want to do this slide. You don't want to manage your liquidity by lending money out to people and then all of a sudden saying, sorry, I need that money back. Legally, you're permitted to do that. You just don't want to be that entity. And you don't want to lose customers. The banking industry is competitive enough that if you do this even once, you're going to lose a lot of loan volume. And that's how your bank makes money, right? The difference of borrowing short, lending long. Well, if you can't lend long because no one trusts your bank anymore when the loan's made with it, you're going to lose a lot of money. So we had liquidity management. Then under asset management, again, what we're looking at here is the, when we're looking at in terms of this problem here, we're saying, are we getting assets that have an acceptable low level of risk? And are they diversified? So as I said here, with Central Pacific Bank as my example, and again, it's not necessarily the large commercial banks that the book is going to use as its examples, that when the bank decided to lend for undeveloped property in California in 2008, 2009, it saw it as a way to get the highest possible return on the money, right? Undeveloped land at some point becomes developed land, which means that I bought it cheaply because it was undeveloped. And if I wait just a few years, it's going to become developed and sell very expensively. But it didn't have elements 2 and 3. There was obviously a great deal of risk involved. And then once the financial crisis hits, and you've got a housing crisis, I don't have a lot of liquidity either, meaning an ability to turn the money into cash. When I'm trying to manage these assets, there are 4 key tools I would try to use here. First, I'm going to try to target my marketing as a bank to find borrowers who are going to pay the interest rates that are high enough and where the default rates are low enough. So for instance, as a state employee, as a college professor, I can get a loan apparently with Banco, and the mortgage is supposed to be cheaper. I think it's because, right, state employee, I'm probably not going to lose my job based on how the economy is doing. And presumably, because it's a state job and I'm a college professor, I probably also have the tendencies to never want to default. The bank as well, when it's purchasing securities like government bonds, it can purchase those that have a higher rate of return relative to the risk it's taking on. They can diversify that risk with the loans that they make by diversifying in who is borrowing from them. As a different example of this, there's a bank in upstate New York where most of its assets, most of its loans, were for these medallions that had to be on taxi cabs. While when Uber and Lyft entered New York City, it decimated the taxi industry in New York City. And as a result, that bank, um, I don't think it failed, but it did very, very badly, primarily because all of its loans were made for the purchase of taxi medallions. And then finally, the bank needs to um, balance how much liquidity it needs with lending that money out and getting some higher returns, but knowing that you're going to have to wait longer to get the money. And it's kind of, you can try to manage it well, but in some extent, it isn't an exact science. And it's become more complicated by the fact that you just have more options out there for storing money for a short period of time. You used to just go to your bank and just put it in your checking account. But checking accounts are not as important as they once were. Instead, you've got individuals who are directly participating in the overnight rate and shopping their money across the country. Then, number 4, we've got capital adequacy management. How much capital does the bank need? That's largely determined by regulators. You don't want to have so little that customers, depositors don't trust you anymore. So generally, banks will do a little bit more than what regulators require. And you can see here under the high capital bank sides of this graph, you've got of table, you've got banks that if they have enough bank capital, they can avoid bank failures. And we can see that here, where then we want to calculate the return on assets and the return on equity, ROA and ROE. And when you look at investing in bank stocks, you automatically look at these numbers in addition to looking at the net interest margin, NIM. The return on assets is going to be the ratio of my net profit after taxes to my assets. The return on my equity, that's basically the wealth of my company, is going to be the net profit after taxes divided by the equity capital. And then I'm going to want to see how these two change over time as well, where I have an equity multiplier multiplied by my return on assets equaling my return on equity. Profit versus the assets that I have there total. How big of a margin of a business is this? This is essentially what we're looking at here. Then under capital, continuing on with capital asset management, what you're trying to do here as well is you're trying to get obviously the highest return you can, but you do need to take into account that lending out more and more money, the money starts getting invested by the businesses that borrow it into aspects of the business that don't make as much money. So the return on equity is going to fall. Again, I'm just going to skip the application there. Credit risk, again, is the risk that arises because the borrower is made default. So this would be basically the loan application process, which, again, I borrowed money for a house, my wife and I. Both of us, I'm a professor, she works in finance. We both make enough money that I don't think either of us had ever undergone that kind of screening and monitoring that the bank did. in terms of the lending process. As an example of this, right, when you borrow money for a house, you have to put money in escrow, meaning in basically an account that you have no control over, so that the bank can put it towards the property taxes being paid. Why? Because the bank, if I don't pay my property taxes, then the city and county of Honolulu can take over ownership of my house, which the bank totally does not want, because they lent the money to me and the house is the collateral. So they don't want to lose the collateral because I failed to pay the property taxes. Same with insurance. Homeowners insurance is paid for by the bank, because as long as I've got a loan, the bank has a vested interest in me repairing the house if it gets damaged because of a storm. You can also do this, you can manage the credit risk by having long-time customers who have multiple types of accounts with your firm. And obviously, again, posting the collateral. Right? If you can post 20% as a down payment, you're less of a credit risk because you've already put down a fifth of the money. And then the final factor, again, for the general principles of bank management was all about managing the interest rate risk. How much do earnings and returns, how much do they change based on the interest rate changing? And so then what you start to do is you start to separate out your assets and liabilities that are sensitive to the interest rate. So you have some idea of the degree of variability that exists. And part of this you do with a gap and duration analysis. In the gap analysis, you're basically subtracting out your rate sensitive, meaning interest rate sensitive assets, and subtracting from that your interest rate sensitive liabilities. Multiplying that by the change in the interest rate so that you get a change in potential bank profit, that gives you an idea of how variable the bank's earnings are going to be. Profit's going to be, essentially. And I think they mean maturity bucket, not bucked approach. Bucket approach. In the maturity bucket approach, you're basically going to control for interest rate changes by spreading out, laddering what you've all lent out to others, so that, and across even other banks, so you have some degree of protection. In terms of activities that occur off of the balance sheet, this would be many banks, when they issue you a mortgage, most of the time they don't hold on to that mortgage forever. And so they sell it to some other agency. Same with many of our student loans. Some student loans are still given by the government, but if you borrow money privately, even if it's guaranteed by the government, it's going to be sold to someone else, or it's going to be serviced by someone else. So even though in my case, even though I got my mortgage from Central Pacific Bank, it's actually serviced by some company on the mainland. And in managing these off the balance sheet activities, the other thing I need to manage for is the extent to which there's a principal agent problem. Meaning, again, is there a difference between the people who work at the bank and manage that risk versus the shareholders of that bank? Are they acting with this in the same direction, with the same goal in mind? And you would try to control for this with some internal policies. And so, for instance, my wife is in finance. She invests money for other individuals. She has a book of business, right, of total assets she manages for others. She is required, as am I, as a spouse, to not open up any like trading accounts with other firms. We have to keep it at the firm that she works at, because that's how the bank can make sure that that my wife is behaving appropriately in terms of how she, right. So it's not that she tells clients buy Nike, buy Nike, buy Nike, and then she privately is selling it, right, and it's just driving up the price. That's supposed to at least avoid some of those conflicts of interest. Now, it is true, this happened quite a while ago. I think in the early 2000s. Barings Bank, very old bank, old industrial bank of England, had a trader, I think it was in Indonesia or Hong Kong. But that trader in that in the Asian operations of Barings, the British bank, basically made a bunch of really bad bets. And those bets in the markets went bad. And it caused the entire bank to fail. Because Barings, the bank, did not manage the investment activities of that trader. Okay. With this in mind, then, I hope that gives you some understanding of the challenge of a bank and how it runs its operations as a business, and how much time is required for that bank, and effort is required for that bank to be able to make money.